Good afternoon, everyone. On behalf of Team IIFL Finance, I thank all of you for joining us on this call. I am Rajesh Rajat, CFO, accompanied by Nirmal Jain, our Chairman, R. Venkatraman, Managing Director, Sumit Bali, CEO, and Qtr4 CRO. I will now pass the call to our Chairman to comment on overview of the group strategy and plans.
Thank you, Rajesh. Thanks and welcome to all the participants, all the investors, and we have equity as well as debt investors on this call. I think I won't take much time on COVID-19 because everybody has a lot more information on this, but one thing is sure that nobody knows what's going to happen in future. So the uncertainty was never higher. I mean, nobody has a vague clue also what's going to happen. And under these circumstances, we still have to plan for future. And this time, I think we have done a lot of internal brainstorming and a strategy discussion even at board level. So in our presentation, I'll just take you through the few slides which are different and which can be a completely business model, which can be game changing, which can be life changing for the business. And that is, I'll take you through the thought process that we have. And so if you already have presentation with you, then I'll be covering from slide 20 to slide 36. And even if you don't have, you can just listen. So today, in terms of risk, as I said, that the future is so uncertain that everybody has no clue how and when things will sort out. So on one hand, you have a virus and pandemic, which is going to pan out in a way which nobody knows today. And then on the other hand, you have a response of Government of India as well as RBI. Where till now they have provided for some liquidity. The number of schemes have been announced. And many a times when they announce schemes and the way they get executed, there's a lot of lapses in terms of the intent and the way execution happens. And at the same time, there is nothing that government has done till now to make up for loss of income of MSME or very small businesses that will be impacted. So maybe in terms of risk, if you look at the worst possible or a worst case scenario, then there are 5 major risks that we have identified. One is that the slowdown and the recession or depression, whatever you call it, in the economy, which is quite possible, can cause a significant deterioration in the quality of assets. And in terms of business loans or the real estate projects as well as maybe, to some extent, home loan can get impacted by this. The two NBFC liquidity crisis has been there for now 20 months. Things got a little better in between, but they again deteriorated. And today the banks are risk averse and they perceive NBFCs to be risky businesses. So the NBFC liquidity crisis may not have an easy answer or easy solution. Many times when government pushes liquidity ease for a month or two, and then something can happen and again it can get into a crisis. So we are in a sector where liquidity problems can be continuous and perennial, and one has to really take that into account. Third is the negative sentiment about financial sector has impacted the stock valuations, and obviously that limits our ability to raise equity. And even with a significant dilution, you can raise small equity, which is not going to solve the problem. Number 4 is now it's going to be an uneven playing field because as we have seen that not only in NBFCs, even in banks, the money and the deposit is flowing into a handful of banks, maybe 1, 2 or 3 or maybe 4, like State Bank of India on a large base. I mean, they are the largest bank. They are almost about 20-25% of deposit, if I mistake not. There are 800% increase in the month of April. So if this kind of risk aversion and polarization continues, then there will be a handful of banks and maybe very few NBFCs that probably will have the liquidity and money. And some of those are getting money at very cheap rate, and there are many other NBFCs that are finding it difficult to raise any liquidity. So this kind of uneven playing field can happen. And the fifth is, as the lockdown continues for a very long time, people are working from home. There are operational information technology and cyber security and all kind of risks. So in these 5 risks that are major risks that we talk about, let's not lose sight of opportunities. And in fact, there's no crisis which has, at least in the history of mankind, there hasn't been any crisis which did not have opportunities hidden in them. One is the entire digital technology and e-everything, whether it's e-KYC or sign, e-documentation, now is getting accelerated. And, having invested a lot in digital technology and being pioneer in many of these technologies, we are quite excited by this. The paperless, physical, presenceless, loans, disbursements, all those things can now become possible. Although technology existed, but there was reluctance, there was resistance to adopt it wholeheartedly, so these things are changing. Two, banks are getting huge liquidity, as we have seen that 8.5 lakh crore of surplus bank money is with RBI. They're just earning about 3 or maybe 3.25% or 3.35%. Currently, obviously, they can't continue this kind of scenario for too long because their margins will be impacted. And obviously, they'll have to find, even if they don't want to lend to NBFCs, they'll have to find retail assets. Because in the economy, we aren't seeing too many wholesale assets or wholesale projects, asking for funding. And if they need retail assets and they don't have the last mile connectivity with the customer, then, companies like ours with huge network will be there in demand. I mean, we can source assets for them. Then third opportunity is unprecedented cost saving opportunity. When people work from home, what we've seen in the last couple of months, you save a lot of cost. People are working, sometimes their productivity is higher because 20-25% of time they were losing in commuting, they don't lose. It also allows you to do delayering and create a flatter organization because in office, if people think that 10 people may need a team leader, but when we realize that people working from home on a remote basis, telecommuting and all those things can save a lot of cost. Fourth is that the consolidation which will happen because of these kind of, as I spoke about, polarization of the funds as well as the confidence in the trust. And there'll be capital constraint, which will cause capacity contraction because many smaller NBFCs and many smaller private sector banks also may find it difficult to continue the lending operations, and therefore those who survive, they will have an opportunity because on the supply side you'll see contraction, whereas on demand side as things recover, hopefully expansion will again start. Now the fifth thing is that people, what we have seen in the last couple of months, at least in our group company, that a lot more money has started flowing into mutual fund stock markets and many new customers have started coming to the market. And actually the hypothesis is that people are uncertain about future. They start spending less and saving more. Then there's a great cross-sell opportunity for companies like ours where all our branches are also named as loans and investment center, where we get a significant referral fee from the group company for cross-selling investment and insurance products. So in this kind of scenario, what do we do? So, in fact, the new business model that we want to work on, it's a pun is intended, but is also named that we want to build a COVID organization. And the COVID CO stands for capital optimized and VI stands for value innovation. So it's a capital optimized value innovation driven organization. So let me broadly what it is. We own the customer but sell the loan. Then we have a revenue model which is rising stream of spread income or the difference between the yield or the rate at which we have sold the asset and the rate at which we charge the customer, and also the cross-sell income because we own the customer. In fact, many of you who have been tracking the company would know that almost 40% of our loan AUM is already sold to banks. And this is something, if we work on this business model, we can take it to what our target would be to 75-80%, and then the remaining money can be just funded by internal accrual. Now we have a real estate portfolio which is now down to 12%. We have to ring fence it, just be the sponsor for the fund or an SPV and try and release capital. Now this work we started earlier, but unfortunately because of the COVID-19 disruption, this thing has got a little delayed. But still, as soon as things get normal, we have to complete this project. And there are quite a few funds who are interested and we want by attractive yield. And of course, IIFL can be the sponsor for these kind of fund or SPV. So, maybe broadly we target. Now, these are things which are unprecedented, but at least we say we keep a 9-month target to forge bank relationships, align the workflows, integrate technology, and work out this completely new business model. So when we say capital optimized, what does this mean? IIFL has a branch network of 2,377 branches. 430 were set up in last 1 year, which again, throughout the year we had liquidity problem, but we are convinced about the retail credit in this country and we kept growing. In 25 states, 600 cities and towns covered. We can leverage our network to source the retail assets, and banks get relatively superior quality of assets, not only because of our network, but because of our expertise and understanding of the business and priority sector retail assets also. So it becomes a win-win relationship, and this is something that we can do with multiple banks. So it's a capital-light NBFC which owns the customer, and we can do rapid technology integration because all banks have technology systems which are taken from large technology companies, or some of them are proprietary components. Our advantage is that we have a 300 people team and all our technology is in-house, and therefore it gives us an advantage to integrate and be flexible. Now, when banks are acquiring assets using NBFC, and they've been very keen, we have seen in the last 18-20 months that they've been a willing buyer of assets all the time because they are flush with funds and they don't have retail assets. So they give a direct assignment of loan assets. RBI has also announced on-lending scheme where they just fund us and that becomes priority sector for them. We originate assets and give it to them. There's also refinancing available from NHB, SIDBI and NABARD, and also co-lending which has not taken off. But there's another model which is, at the origination itself you can give to the bank. So in a way you act like an agent, but it's not a DSA agent, but it's a lot more than that. Because what you're doing is that you're doing credit underwriting as per bank guidelines and bank parameters, but also you service the customers, you do the collection, and throughout the life cycle of the customer, you are engaged with the customer. And of course, we have redesigned to meet the requirements of each and every partner bank. So this is the capital optimized model that I was talking about. In terms of value innovation, we just focus on a few products that are our core: home loan, business loans, and gold loans. We already have 40 lakh or 4 million customers. If you focus on this, then we achieve scale. Now also, we have seen that the flexible staffing, work from home can save cost. We have invested a lot in digital technology and automating the processes, so that gives us a cost advantage. From customers' point of view, we become one-stop shop. We can offer him all the loan products at the best rate because we have a relationship with the banks where we can get them for a high credit score customers the best possible rate. We have a lifelong engagement with the customer and can sell multiple products to them. And as I said, investment product expertise is there in the group. We have a unique mode in loan origination and loan collection. Although there are many startups who have come and thought about this business model, but we have been there for more than 2 decades in the industry. And our physical network of such large number of branches gives us direct contact with the customer and understanding of how actually the credit underwriting standards have to be implemented. Our digital presence through website and app is also very strong. There are millions of people who use our app and website. We have a proprietary technology which is tablet, which works and gives a very high level of security because in this we have invested over the last 3 years. So even our gold loan branches don't have any PCs or cables or wires. People work on mobile, but they are very well controlled digitally. And then there are centralized paperless processes. So this is the mode that we have, and loan origination, collection, all that we can do. Now, this business model is very ambitious. It's something which is in a way revolutionary. And what is our dream and how ambitious this is? If I can summarize what our dream can be to achieve in 3 years' time in 3 words. It may sound outlandish. It may sound very ambitious or even oxymoron, but if it works really well, then we can become a debt-free NBFC. So even if we don't achieve 100% of our dream, even if we achieve 80%, 60%, we would have created a completely different business model, and which is so capital light. I started my career in Hindustan Lever, and I can really, I can understand, I appreciate the pleasure and fun of working in a business where you don't need capital to grow the business. So that is the business model that we want to work on. Now I'll very quickly take you through the liquidity, where maybe liquidity you'll talk about. Okay. Okay, one more section that we have added because there have been a lot of concerns about the real estate projects that we have. So we appointed JLL and PwC to do a diligence in last quarter on each and every project. And we appointed few more agencies to do them on a continuous basis. And we have included certain analysis based on stage of project completion, the target segment, whether it's affordable, mid-income or high income, the geographical distribution, the developer track record, and also sensitivity to price fall which can happen because of COVID and the resultant slowdown in the economy. So if you really look at very broadly, I think you can go through these slides. I won't take much of our time, but 92% of projects that we finance are residential, and therefore our vulnerability to commercial price fall, which is now feared more, is much lesser. 60% of our projects are in advanced stage of completion, and these are the project by project details that we have worked out. 76% of projects are affordable, where the unit value is less than 50 lakh rupees in most of the cities like Bangalore, Hyderabad, less than 1 crore rupees in Delhi and Bangalore, Calcutta, but in other cities less than 50 lakh, and in Bombay less than 2 crore rupees. So there's a classification of affordable housing. Suburbs of Mumbai and Gurgaon, which have been high velocity regions, they account for 52% of our funded projects. 93% of developers that we have funded have more than 10 years of successful track record. And 97% of funded projects, even if you provide for say 25% fall in the real estate prices of Mumbai, or in a commercial prices of fall by 20%, or in a correction like this, then also they will have a cover of more than one time for our loan and interest thereon. So this was a little bit of deep dive into the real estate project that we have. I'll hand it over to Rajesh, our CFO, to take you through a little more granular details of our finances, and then we can open it for Q&A. Thank you.
Thank you, Nirmal. I'll just give you all a brief update on the business, liquidity, and the COVID impact and other sections. On the business side, IIFL Finance net profit was rupees 216 crore in the fourth quarter, up 16% quarter on quarter, and flat on a year-on-year basis. Net profit for the year was 756 crore, up 8% year-on-year. This is excluding one-time impact of COVID-19 provision of rupees 211 crores net of tax, a deferred tax reversal of 50 crores, and gain on divestment of CV business of rupees 94 crore in the previous year. Loan AUM grew 9% year-on-year and 5% quarter-on-quarter to 37,951 crore rupees. Core segments grew faster at 12% year-on-year to 32,773 crores. Retail loans, including consumer loans and small business finance, constitute 88% of our loan book. Our Tier 1 capital adequacy stands at 13.6 and total capital adequacy stands at 18.2%. Primary drivers of our AUM growth are gold loans, which grew by 47%, and microfinance loans, which grew by 49% year-on-year. On the other hand, construction and real estate finance and capital market finance declined on a year-on-year basis. In home loans, our focus remains primarily on small ticket loans with salaried and self-employed sections. The fastest growing segment in home loans is the affordable home loan segment, or Swaraj loans, with average ticket size of rupees 13 lakhs. IIFL Home Finance has been a significant player in the Pradhan Mantri Awas Yojana CLSS scheme. Till date, it has approved benefits to 38,300 customers and disbursed subsidies of nearly rupees 900 crores. Another strong characteristic of our loan book is the large proportion of loans that are compliant with RBI's PSL norms. About 63% of our home loans, 48% of business loans, and 91% of microfinance loans are PSL compliant. In aggregate, nearly 43% of our loans are PSL compliant. The large share of retail and PSL compliant loans are of significant value in the current environment, where we can sell down these loans to raise long-term resources. Our average cost of borrowings at 9.4% for the quarter remained flat Q on Q, and for the year rose by approximately 40 basis points. We added 430 new branches during the year, taking the total to 2,377 branches. Consolidated gross NPAs and net NPAs recognized as per RBI's prudential norms and provisioned as per ECL method prescribed in Ind AS stood at 2.31% and 0.97% as of 31st March. This was against 1.96% and 0.63% as of 31st March 2019. Provision coverage, including standard assets provision under Ind AS norms on stage 3 assets, was 128% for the quarter. Coverage excluding the additional provision made for COVID impact still stands at 88%. Return on assets for the year was 2.2% and ROE was 16.9%, excluding impact of one-off items. A brief update on liquidity. Access to long-term funding we raised rupees 1,169 crore through term loans and refinance from banks. During the quarter, we also raised $400 million or rupees 2,855 crores through our medium-term note issue. We continue to have nil exposure to commercial paper. Our funding mix is well diversified, including 28% from NCDs, which include subordinated debt and MTN issue, 35% from bank term loans refinance and NHP refinance and working capital finance, and 33% from securitization and assignment. We completed securitization and assignment transactions amounting to rupees 2,308 crores in Q4 compared to 2,382 crores in Q3, 3,721 crores in Q2 and 4,595 crores in Q1. We sold down both PSL and non-PSL loans in 5 product categories, including home loan, LAP, SME, gold and microfinance to public sector, private and foreign banks during the year. A brief update of COVID impact. As of 25th May, 58% of our consolidated book was under moratorium. An additional provision of rupees 282 crores was made based on increasing probability of default by 20 to 25% depending on the product for all retail products. For wholesale products, we have increased PD and LGD across all customers based on a detailed case-by-case analysis. As lockdown starts to lift and as and when RBI and government measures start reaching end customers, we expect things to start improving. Brief update of digital. We have continued our focus on digitization encompassing every aspect of the customer loan journey. During the quarter, we launched one-click digital personal loans to help customers with a good track record with their short-term funding needs. We are also offering our existing home and gold loan customers top-up loans through an end-to-end digital process. IIFL Loans app is being increasingly used for various transactions by customers and has been especially beneficial during the lockdown, giving customers ease and convenience of access. We have about 150,000 average monthly active users on the app and have maintained ratings of 4+ on Android and iOS app stores. Analytics. In analytics, we continue to drive the use of credit decisioning engine, artificial intelligence and machine learning through behavioral collection and fraud scorecards. This is continued focus on cross-sell and win-back, with our analytically driven gold loan win-back generating strong volumes for both gold business as well as group-wide products. During the quarter, we also increased our efforts on campaigns related to promoting digital collections and digital disbursements. That brings an end to the update. We will now open the floor for questions and answers.
Sure. Thank you very much. We will now begin with the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking questions. Also, before we begin, we'd like to inform participants that in order that the management is able to address questions from all participants in the conference, please limit your questions to 3 per participant. Should you have a follow-up question, we request you to rejoin the queue. Ladies and gentlemen, we will wait for a moment while the question queue assembles. To ask a question, please press star and 1. The first question is from the line of Prashil Shah from Qtr4 Capital. Please go ahead.
Hi, could you throw some light on how you reached the COVID provisions of 282 crores and some stress testing that you would have done for your business segments apart from real estate?
So when we did our COVID provision, we did a detailed analysis of our retail portfolio. Within the retail portfolio, we increased our PDs by about 20 to 25%. And when we looked at our wholesale portfolio, we did a case-by-case analysis, and there again the PDs and LGDs were increased to give impact to the amount of stress which could likely arise due to the COVID.
And what about your business loans, the small business loans?
So within the small business loans, we increased the PDs by 25% for the unsecured bit, to factor in perhaps increased future probability of default.
Okay. And could you also share some of the, what percentage of your business loans or microfinance would be in the essential services? And could you give us some idea of what kind of loans you've given in the business loans and microfinance?
Yeah. So business loans are pretty granular. So these are mostly sub 15 lakh loan, and these are also covered under the CGTMSE scheme from SIDBI, and the yields are close to about 19 to 20%. Overall, the book comprises the 2/3 of loan against property and 1/3 against business loan. Your second part of the question was on microfinance. That's largely for income generation activity for the self-help groups comprising of women.
Okay. All right. And I have a question on liquidity front. So on your slide number 3, you have said that you have bank equivalents of 1,900 crores and undrawn credit lines of 3,500 crores.
Yeah. So the 3,500 crores as of 31st March, that slide explains that. And the 2,200 crores in slide number 29
yeah.
25th of May.
Okay. All right. So there's
some of the kind of lines would have been used to repay the loans outstanding in April and May.
Okay. So basically, it's just the timeline. Timeline is different.
Yeah. Chart number
29 is more.
as of 25th May and chart number 30 is as of the financial year 31st March.
Okay. Thank you. I will come back in the queue if I have any further questions. Thank you.
Thank you very much. The next question is from the line of Varun Agarwal from Factorial. Please go ahead.
Hi. Thanks a lot for your time on this call. Again, I wanted to take you back to slide 29. Can you please run us through the various potential scenarios in this with respect to both the MF insurance and the bank FIs? How do you see this panning out? And in addition to this, would also be useful to get some scenarios from you on the asset side. So I'm basically looking at your net funding situation, and how do you see that panning out given the moratorium which is there in the book? Again, nobody has full visibility on when the lockdown, etc., will end. But what are you seeing and how are you sort of looking at it? Thank you.
So there is a lot of uncertainty about whether NBFCs are getting moratorium or not. So the industry has been representing to government as well as RBI. Several representations have happened because it becomes very unfair that RBI makes a blanket announcement so that all the NBFC customers can take moratorium, but NBFCs don't get moratorium from their principal lender banks. But most of the banks now, I think, are looking at moratorium favorably. Some of the banks have agreed. Some of the banks are, in the processing it. So what we have done in this chart is that we have separated the loans which are due to banks, and when I say FIs, are institutions like NHB, who will also follow from the same pattern. And then there are loans, repayments to mutual fund and insurance companies, where the bonds and NCDs or maybe the public issue to public. So the bottom blue chart is something where we don't see any moratorium possibility. But the upper part is basically loans which are due to banks, where I think most likely scenario now is that the moratorium will be given. So if you look at, say, for July, for instance, we have 286 crores due to, say, mutual fund and insurance companies, and we have 1,271. This is on top of that one. It's a cumulative. So maybe 1,271 minus 286 is what is due to banks. That is where we are likely to get moratorium. So if you really look at it, if we get the moratorium from the banks as likely, then our liquidity will cover even beyond December 20. If we don't get any moratorium, it might be up to September till now, whatever we have, or anything in between. So this is how the chart is.
But obviously, this assumes zero inflows from the asset side, right? So this is as per your
Zero
existing
inflows from asset side. Okay, it means zero inflows from asset side, but okay. And also we have operating costs of running the business. But net, even with the we also have a going concern. So we are also continue to give some new loans. But for hypothetically, if we stop disbursing new loans and we keep only collect the EMI and collections from our existing loans, how much will be collected, Sunil, on the monthly basis? Now we are close to about 250 odd crores. On a net basis, we'll have 250-300 crore rupees coming from EMI, even after moratorium.
And your ongoing costs are per month?
So fixed cost will be around 70-80 crores. Maybe they will also get rationalized.
Okay. So that's very useful. The other question that I had is with respect to the various schemes that the government has announced. It was starting with the TLTRO, etc., which didn't really have the desired impact, and then they have announced subsequent schemes. So can you give us some sense what could be the impact on you as an NBFC? I'm not talking about your eventual customers, but as you as NBFC, how are you looking at it? Thank you.
No, I think there are a lot of liquidity schemes, and we as an NBFC are reasonably well placed because the one scheme is only for AA and lesser, or not for AAA. So we are AA stable rated. So we obviously tend to benefit from that. So there are a number of schemes. So there's a TLTRO, then there's a 30,000 crore rupees liquidity finance for NBFCs for 3 months, but might get extended. Why they give for 3 months? Because to meet the moratorium equivalent. Then there's a 45,000 crore rupees of another scheme which is partial guarantee in a different format, where earlier partial guarantee was only for the pool or where you're selling certain assets to banks, but this can be even for bonds or securities issued by NBFCs. And on top of that, there's 3 lakh crore rupees of MSME working capital loan which can be guaranteed. So there also our existing customers where we give an MSME loan, we can give them some 15-20% additional loan, and that is that top-up loan or the last mile loan is guaranteed by the government. So there are quite a few schemes. Their final guidelines are coming. And then, of course, we have the more TLTRO. All these things put together, I think, fairly, there's a very positive that in the next few days or next few weeks, we should have some good liquidity coming in from these, from banks and from other institutions.
Do you have some kind of very rough ballpark numbers? I'm not tying you to any particular number, but what sort of, just like you have very nicely illustrated in the chart 29 about various liabilities, is there any sort of range you can give us on what additional sort of direct benefit you can get from this? I'm excluding the 3 lakh crore MSME working capital guarantee scheme because that probably goes to MSMEs directly. But as far as you are concerned, is there any scenarios you can give us? Thank you.
Yeah. So from all these schemes we can get, it depends, because we really don't know how banks have to process this application. But maybe around 2,000 crore rupees, 2 to 3,000 crore we should get. And on top of that, we also have the normal applications which are about on lending as well as term lending, which is in the normal course. So I think our target will be to raise maybe 5,000 to 6,000 crores in the next 4 to 6 weeks and keep that kind of buffer in case under the scenario that we try and work for, so that you can continue to grow your book and feel comfortable with that.
Sorry, just to understand that, what you mean is that this cash and undrawn line cushion that you have 2,200 crores, you would hope to get it up to 5,000 to 6,000 crores in the coming weeks. Am I right to understand that?
Yes. 5,000 to 6,000 crores. Yeah. Right.
Thank you so much. I'm done.
Thank you. Next.
Thank you. The next question is from the line of Anita Rangan from HSBC Asset Management. Please go ahead.
Yeah, hi. Just a few questions here. As of now, you have said that 58% of your customers have availed moratorium. So once the moratorium is off, by when do you expect that 100% will be restored? Say between August to December or August to March? when do you expect it to be restored?
This figure is as of end of May. Our sense when we reach out to our customers, specifically in the SME sector, I think they are sitting on liquidity, but they want some kind of opening up. So I think once this 3 lakh crore reaches the end customers, you will see that number of customers who availed moratorium will reduce next quarter. Gold, we've already started seeing activity, which is picking up. Gold now, the LTV is historic low as the gold prices have gone up. So we expect gold in probably after 3 months, sometime at the end of 3 months, situation should be pretty close to normal. Microfinance would take anywhere around 3 to 5 months is our sense. So my sense, I think 2 quarters from now, we should see about 80% of normalcy returning on the collection side.
Okay. And you spoke that you also have to do some kind of disbursement. So is that like a part of your contractual obligation for the money which you have to disburse, or it is like even like, normal course of disbursement?
So we have some disbursement linked to construction, home finance. Now, given that construction also would be delayed, that also would get delayed. That's all. I mean, we don't have too much of undisbursed sanction or undisbursed line. There may be some in the real estate book, but very insignificant.
That be like, your disbursement, which is like, you have to like do, especially when it comes to construction finance per month?
So there's a home loan. What happens that supposing you bought a home for 25 lakh rupees, they give you 20 lakh rupees loan, but pay with the building and under construction. So with every slab we keep paying. So we have to keep, let's say we are giving 80% loan. Then with every installment that you pay to the developer, 80% comes from the lender.
Right.
But these kind of things are very small. They are not very significant compared to our total book.
Okay. And just one more. Out of this 1,169 crores which you have refinanced, like financed in Q4, how much would be like a refinance of, like, say, once the existing term loans are over and you get that substituted the new loan or working capital refinance, and how much would be new, fresh sanctions from, say, new banks or completely new term loans?
Sorry, I think I didn't quite get your question. Are you asking how much is renewal and how much?
Yeah. How much is fresh loans? Yeah.
I don't have that information right now, but I think most of it is fresh.
Okay. Just one final question. What are your thoughts on securitization? Like, because you have been doing securitization in a very robust manner until Q3. So, I mean, what are your thoughts there? Because Q4 you haven't been able to do because of COVID situation and so on.
So mostly securitization transactions consummate towards the end of the quarter. Unfortunately, in Q4, suddenly it came to standstill on 20th of March. So transactions, the pipeline got a little delayed. We could still complete a few, but I think now most of the banks are trying to work completely digitally and even without physical thing. But I think they will gain momentum as things open up. Normally what happens, the securitization transactions will have rating agency rating. Sometimes we'll have auditors who basically audits, and sometimes they do random checking of KYC files and the borrowers. So all these processes, they work in a normal environment, but they slow down because of the lockdown.
Okay. All right. Yeah. Thank you.
Thank you. The next question is from the line of Sivakumar K from Unifi Capital. Please go ahead.
Yeah. Thank you for the opportunity. With respect to the home loan segment, what will be the salaried and self-employed bifurcation?
So 58% of AUM is salaried, 42% is self-employed.
Okay. And so in business loans, you said 2/3 are secured while 1/3 will be unsecured. Is that right?
Yeah, that's right.
Okay. So what is the rationale for giving a moratorium by default? Because that seems to be the reason why we are seeing a higher number or higher percentage of the AUM getting into moratorium. And have you extended this moratorium till August again by default?
So we have asked the customers for opting in. So we have given them a choice. So that's the protocol we are following. And the number we set 58% is as of May end. For the next quarter, we'll get to know in about 2 weeks' time.
Okay. And within business loans, is the moratorium higher in the unsecured part, or is it equally distributed between secured and unsecured?
So it's slightly higher on the unsecured part.
Okay. And we see that in terms of GNPA, business loans has again spiked this quarter. Is that structurally worrying you in terms of how the asset quality has been performing over the last few quarters, business loans?
So when you look at it, there has been, even before the COVID economy was soft, post that there has been further impact. Now, given that 2/3 of the book is collateral backed, which roughly runs at about 60% of LTV, and we assessed cash flows of the customer while giving loan, though it is on the past situation. And again, the 1/3 business, which is a business loan, is a higher margin business. So this is a business where there will be some pain in times to come because these are loans given for generation of income. So last 2 odd months of closure of business activity would result in some pain in this segment. But we are also watching it closely. This 3 lakh crore, which is roughly 20% of the entire outstanding, once it reaches the customer, it will help them in restarting the business, and ease the cash flow for them because it has a staggered repayment schedule. So we'll have to wait and watch as to how things open up, how much time it takes to get to normalcy. But given that we are 2/3 of the book secured, 1/3 having higher margin, we are not unduly worried on this segment.
Okay. And the entire AUM of business loans will qualify for that 3 lakh crore scheme?
Yeah.
Got it. And finally, one question on the construction finance book. We see that it has increased by 2% on a sequential basis. But the understanding was that we would actually bring it down over the next 6 months. So should we actually expect increase in the construction finance book going forward?
No, there are some disbursements that happen based on where the pending approved amount is there, and disbursements happen with the approval and with the progress. But what happens is the collection was impacted in the last 10 days. And many of these installments become due in the last 10 days. And that is what has impacted this. But it is unlikely to rise. Actually, with some resolution or some project getting moved, it could have fallen, but for certain lockdown and things that came to standstill. So under normal circumstances, it should start tapering off.
And what is the yield for the gold loan book?
19.6%.
Okay. That's it from my side. Thank you, sir.
Thank you. The next question is from the line of Shubhranshu Mishra from BOB Capital Markets. Please go ahead.
Hi. Thank you. Some of my questions have been answered. My question is about the gold loans. Have we offered moratorium to our gold loan customers?
See, in case of gold loan, what happens, the branches are closed for more than 2 months. Now they just opened. So normally moratorium becomes automatic because even if customer wants to pay, say, digitally, but he won't do that till he's getting his jewelry back, he or she. So almost 82% of gold loan, if you see, are applied, then they are under moratorium. But as the branches open, now in last 1 week and we have seen a lot of traction on this. Almost 90% of our branches are open. Customers are coming back. And hopefully the moratorium will go down now, actually, as many customers will just, pay their interest or, release the gold also.
No, my only question here is that how can we offer moratorium on gold loan, because moratorium is only to be extended on term loans and not on bullet loans. Gold loan is a bullet repayment loan.
That's gold loan.
As per the RBI regulation, we can offer moratorium on gold loans.
First of all, gold loan has multiple products. It's not necessary that it has to be a term loan or a bullet loan, because there are many gold loans that are repaid in a monthly installments also. And in this case, I don't think RBI has any restriction on bullet loan versus term loan. And most of our gold loan customers are also small businesses. They basically take a loan against the collateral of gold.
No, I understand that, but gold loan, the understanding is that it's a bullet loan. And RBI clearly mentioned that the moratorium is to be extended for a term loan and not to a bullet loan.
So the bullet loan is also term loan. I don't think bullet loan is to the exclusion of term loan. So term loan can be paid in a bullet manner or can be paid by EMI installment. So many times even when we borrow from banks, it's a term loan but paid bullet. So bullet loan is a part of term loan.
Okay, sure. And what is the outlook on the gold loans as we go forward into FY21? What kind of growth?
Very positive. Gold prices are holding up high, and high as people need working capital to start their businesses or because they're impacted by this. I think gold loan outlook is very good.
So, would you see a volume-led growth or a value-led growth?
Both.
Sure. Thank you.
Thank you. The next question is from the line of Lucinda Zhu from Allianz Global Investors. Please go ahead.
Hi, thank you for the presentation. So my question is pretty similar to, part of it has been answered previously on gold loan. Just I would like to understand also the percentage of AUM under moratorium for this gold loan is actually pretty high as compared to one of your peers who have already announced results. Can I understand why? Is there more or rather less people paying via online ads, or how do you see that?
You're saying the company has a less than this? How much is it? Can you share the number?
They mentioned that gold loans under moratorium is not a lot. It was an article on Bloomberg, and then they mentioned that more people are willing to pay gold loans because it's also they do other loans as well, right? But more people are willing to pay gold loans than other loans because the LTV ratio is pretty low, and on top of that, they do not want that interest to go on as well.
No, so what you're saying is right, but this has come under moratorium in this period because the branches were closed, branches were shut. So by default, they got into moratorium. And also what happens that in our case, most of the loans we collect interest on a monthly basis. So we have to put them in moratorium, and most of the customers would electronically agree for that. But as I said that since last 1 week, branches have started opening all over the country again. And we are already seeing there's a footfall of customers coming back and paying interest and paying. As maybe next few months, you'll see that the moratorium percentage in gold loan will go down significantly.
Okay. Then my next question is regarding your cost of funding. You mentioned about the cost of funding as of end of March. So in the last 2 months, besides the worsening of the COVID situation, we have also seen, some onshore funds being closed. So can we get a sense of how it's affected your cost of funding, and also in terms of the ability to access the market?
So cost of funding has remained stable. In fact, last year was 9.4%. So when we get refinance from NHB and other institutions, we get them at a very good rate. Banks also, although they've been so there is a bit of the entire decision-making process has been stalled. So most of the banks have been waiting for, the clear indications from government and RBI about who's going to underwrite the risk. So it's not that they have said no, but fact of the matter is that new loans have been very slow in the last 2 months. We have raised some money, but not enough. But as we speak, and what we are seeing is that since last few days, last 1 week or maybe a little more than that, most of the banks have become positive. They started looking at the proposals. They started sending queries to us. And it looks like, it appears that in the next couple of weeks, we'll see good flow of money coming as new loans.
Just to add to that, last quarter 9.4 also includes the cost of funding for the MTN program, which was higher, and that was an important diversification and was our main issue. So overall, as banks constitute larger and larger funding portion, the rates would be going down going forward.
Okay, thank you. Yeah, that's all I have.
Thank you. The next question is from the line of Vivek Ramakrishnan from DSP Mutual Fund. Please go ahead.
Good afternoon. Very good presentation. First of all, a strategic question. In terms of origination, whether it's origination distribute, do you feel that you face any resistance because banks have already put in their infrastructure and they have their political infrastructure, and so this getting a product from another institution is something that there'll be internal resistance, and that's why it's not taking off? And related to that is, in terms of the home loan business, is it it's a long tenor loan and NBFCs are generally not able to get over 3 years, 4 years at the very best. Is it best that this business moves to AAA rated organizations and banks?
Come again, what is home loan you're saying?
It's a long tenor business. I mean, when you give a home loan, it's a 15-year loan or a 20-year loan. And NBFCs, typically don't get that kind of tenor unless it's NHB Finance or one of those regulatory bodies. So is it best that this business actually moves more to AAA organization and banks distribute a lot more of home loans and keep it on the books?
Okay. So let me answer both parts of your question. First is that banks are expanding their infrastructure to give loans to SME and they can source on their own. If they could, then 8.5 lakh crore rupees is a hell lot of money for banks to have a negative carry and put it back with RBI at a reverse repo rate. Also, the short-term GSEC rate has fallen below even reverse repo rate now, the 6-month GSEC. So the fact of the matter is that no bank would like to carry liquidity and earn less than their cost of funds, obviously, if they could lend. This country is very large, and the last mile connectivity, the number of people, like companies like ours employ 18,000 people. So if somebody wants to replicate that kind of loan origination, probably will need as many people. I mean, you can say 5% more or less efficient, but you need 18,000 people to replicate what we do. We got 2,300 physical locations all over the country, obviously. So the fact of the matter is that the network, whatever banks have and NBFCs have, NBFCs a loan in the system is 25 lakh crore, which is almost like, we are talking about $30 billion. So NBFCs as a network is very large. And also banks have a large network, but they still can't reach out to every thing. And that is why banks have been willing to buy assets from NBFCs. So they try to do as much as they can. But imagine they obviously can't double or triple their manpower strength overnight. And so that is one. Secondly, housing finance going to AAA, no country, no economy, no system, you can have only AAA because it has to be a normal curve because the country, there are different types of risk assets and everything needs to be financed. So imagine, so even in the banks, that's what I was saying, there is a polarization and there are only 2, 3, 4 entities remain. So how many AAA entities are there? There may be 1, 2, 3 or whatever. A country as big as this can never achieve its dream of $5 trillion economy. Also, what happens that most of the customers won't qualify for this. So the 90% of borrowers, I guess, won't be AAA in terms of their credit score or whatever. Most of them still repay their loans and they meet. But you say that whether it's so let's start from the corporate borrowers, whether they want to have funds for projects and expansion. Then you want to talk about MSMEs who want to borrow for their businesses or individuals who want to borrow for personal needs. If you restrict to AAA, then to give you some data point, out of 10,000 rated companies, only 1.5% are AAA. 98.5% are not AAA. Then I think it will be a disastrous situation for the economy.
No, so I won't belabor this point. What you're saying is logical in the sense that, if you look at even the NPA of a bank in terms of its NBFC loans, especially nationalized bank, in terms of its SME loans, versus the NPAs by a private sector bank or an NBFC, it's much lower. So it's a logical progression. But somehow, I hope that progresses. And on home loans, what I meant was, this search for liquidity. I mean, it grew to 25 lakh crores because we were in a situation of, NBFCs getting abundant liquidity, and it was the story of the moment. But I like your COVID strategy, which makes it a capital-like model. But I'll move on to the next question in terms of
about liquidity from NHB, whether, like HDFC Limited takes refinancing from NHB or we take it. we get it at the same rate. It's based on the underlying portfolio, not based on the rating of the housing finance company.
That's right. So, there is always
our portfolio is very affordable. Some of the loans we have got at a 5.5%, 6% also based on the underlying portfolio.
No, I agree. So in the sense that there will be that component of regulatory finance. In fact, in KLTR also, we believe that, it's the regulators, it's the NHB kind of loans that are going to play a bigger role than anything else. But, more or less, I agree. I just wanted to hear your thoughts on that. In terms of home loans as well as microfinance loans, there's been a jump in gross NPLs. So I wanted to ask whether, is there any split between salaried and non-salaried segment and urban and rural microfinance?
So I think there has been industry-wide impact. One is that the 30 days and 60 days delinquent assets on 1st March got classified as this, but many of them under normal circumstances would have got resolved. So the culture, and this is how industry has evolved, that people know that up to 90 days is not NPA, then they might pay between 80 and 90 days kind of a thing. Secondly, even before COVID, there has been a bit of a slowdown in the liquidity constraint all over. So what we are seeing is the industry-wide phenomena. But having said this, we fare far better than the industry averages or the peer group. So if you put in a tabular format and look at the deterioration in quality of assets of our company vis-a-vis others, you'll find that we have done much better. Like in MSME, our GNPAs have gone about, say, to 3.5%. But the banking sector is at around 15%. For the Mudra loan is more than 20%. And if you look at the average ticket size of our loan is more comparable with Mudra loans, 4-5 lakh rupees loan typically, the median size of the loan I'm talking about. So again, it's a process which is the credit underwriting process and also your collection infrastructure. Then in our branches, your young people who will go and collect smaller value checks also follow up, and your digital infrastructure in terms of how do you digitally engage customers and make sure that collections happen, your underwriting standards which use a lot of analytics. So there are many things that go into this.
Vivek, you also had a question on microfinance. So microfinance, the increase primarily is accounted by what happened in Assam. So we stopped doing business there. We have an insignificant about 2% portfolio there, but there was an issue there, and also in the Mangalore region in Karnataka. So those two impacted it this quarter. Rest all, most of the book is for income generation to rural customers. So therefore, we are fairly confident that this set of customer always had very good intention to pay, and they're very resilient even in the face of floods, cyclones. They've come back, and this time around, the disruption on the economic side is not too severe in the rural areas. So we are fairly confident that as and when teams can operate, meet customers, this segment will also recover pretty quickly.
Thank you so much. That was very useful. The last question, since your COVID strategy is kind of as cheeky, putting it like a dill scoop in cricket, let me ask this question. In terms of, RBI has come in support of banks in a big way. When one bank faced problems, they told, please don't take a deposit away from other private sector banks. But NBFCs have never got that kind of support. Is it possible that also that, you might look at a banking strategy going forward? So you have said that, of course, only few banks have gotten deposits. But by and large, it seems more stable than the NBFC model.
No doubt about it. Actually, we'll naturally evolve into a bank, and opportunity will be there to have a very new age, new era bank which can be far more digital, far more customer centric, and much more lighter, not only on capital but on cost also. So we look at an opportunity, and we can, by in a way, if based on our COVID strategy, if we work very closely with banks and meet the bank's credit standards, the bank's processes, then the transformation will become easier for us.
Perfect. Thank you very much. It was a very good presentation, and good luck.
Thanks.
Thank you. The next question is from the line of Kush from Mahindra Mutual Fund. Please go ahead.
Yeah. Hi. Thanks for the opportunity. Two quick questions. Firstly, just to reconfirm, IIFL Home Finance announced 15 rupee dividend, right?
Yes.
Yeah. So just wanted to understand the rationale. I mean, first infusing equity in home finance.
IIFL Wealth Finance.
No, home finance. I mean, home finance.
Home finance, yeah. IIFL Home Finance is a subsidiary of IIFL Finance.
Right.
So that dividend comes to the parent company, and the parent company had already announced dividend in the month of March.
No, right. So my concern. So I just want to understand the rationale of first infusing equity into home finance business, and then taking out 35% of the equity the next year in dividend. So just wanted to understand the rationale.
Okay, I'm not very sure of the numbers of 35% because the dividend payout is around 15 to 35% as per our dividend policy. One. Two, the track record of dividend also helps, I mean, this is now what you're saying is a logical question, but the way it happens is that when you go to banks, when you go to LIC, when you go to NHB, so in that application, these formats are designed years ago, they look at your track record of profit and dividend.
Mm-hmm.
So you have to build a track record of dividend.
Okay.
That is one. Secondly, home finance is more than 50% of our business. So in the parent company, whatever dividend we have been giving, we don't want to reduce it. It's better that we get dividend from the subsidiary companies in the proportion of profit made, rather than the entire dividend going only from the standalone, which is actually now a smaller business in the entire group.
Mm-hmm. Right. No, so my concern was in FY18 as well as in FY19, we had nothing. So IIFL Home, I think, hardly announced anything, and in FY19 itself, I think IIFL Finance.
No, it's a good observation, but as long as outside shareholders are concerned, the dividend which is given by IIFL Finance matters, and internally, that can be given out of dividend received from subsidiary company or out of standalone profitability. But as we have seen that the subsidiary businesses like microfinance and housing finance have become larger, so we have to upstream the dividend so that we can maintain our dividend track record at the parent level to the external shareholders.
Okay, fine. And next one, for the RE book, so what I understand is around 61% of our book has opted for moratorium. So just wanted to understand, what percentage of the balance 39% would be in natural moratorium?
No, because everybody doesn't have to opt for moratorium.
Mm-hmm.
And, it depends on how the whole crisis is unfolding. So actually, on 31st March, only 11% was under moratorium, and now it's last 2 months, some more have opted for moratorium. Hey, Balaji, you have any comment on this?
Yeah. So just to answer that, the balance book, what we are talking about is that all our RE loans are interest payable quarterly. So there was no moratorium on that. So that continues to be so for the balance book. So the only ones which have opted for moratorium is, as you mentioned rightly, is that percentage which you said. The balance continue to pay their service debt.
Okay. Thank you.
Thank you. The next question is from the line of Sneha Sarawagi from Barclays. Please go ahead.
Hi, I just wanted to know what would be the percentage of digital collections you had pre-COVID and what is it now?
No, during COVID, it has been 100% digital collection actually, because physically nothing was working from 20th March till very recently.
And prior to COVID?
Prior to COVID, our business loans, home loans are more or less fully digital, or direct bank transfers from the customers. Very small part will be cash collection. A gold loan is only one area where we can have physical collections. You have the recovery. Digital collection. So 20% of gold loan is digital and 60% is physical. But we are making very concerted effort to increase this 20% to a significantly higher number by incentivizing and educating the customers.
Okay, thank you.
Thank you. The next question is from the line of Ashwin Balasubramanian from HSBC. Please go ahead.
Yeah, hi. I just wanted to understand the difference. My first question on the liquidity slides. There are two slides which are given 29 and 30. One is on debt repayment schedule and the other is on ALM. So I mean, I'm just looking at the outflow numbers in the ALM slide versus the repayment numbers which I mentioned on slide number 29. So I mean, I'm not able to understand the difference between
the repayment slide is up to December 20, which is just about 6 to 7 months, and the ALM slide for 5 years and longer.
Right, but like even if I look at let's say outflow in the next 6 months, that shows at about 6,300 crore in the slide 30, and in slide 29, if I look at let's say till November 20, it shows only
so that is
38.
So that is only debt obligation. So that doesn't take care of any operational cost and other cash flows that we'll have.
Okay.
So there may be small difference there, but I think there are 5 year and more slides that you look at only the 6 month component, then it may be more corresponding with the other slide, which is just up to December 2020.
Okay, but that is outflow which
is only debt payments, so it won't take into account dividend expenses, operating costs, or other things.
Okay. This outflow which you have mentioned, does that include securitization also?
Yeah, that's right. So the full liquidity slide will have a securitization outflow also, but that we collect from the customer and give it kind of a thing. So there'll be inflow, outflow both.
Right. And I just want to understand on this securitization piece, like given that customers have opted for moratorium and let's say, I mean, particularly in some of the short tenor loans like gold loans, which you've securitized, I mean, like how does it work? I mean, because do you have to repay the bank or the holders of the?
What happens? No, because when you assign to securitize, cash flows, whatever we get from the customer, that only banks will get. And so there is a bit of a confusion on this in terms of how the pools will get rated or whatever. Whether SEBI, because the securities come under SEBI's purview. So there has been some clarification, but as far as we are concerned, so suppose we assign the loan, then it becomes as good as bank loans. If customer pays, banks get it. If customer doesn't pay, banks don't get it.
Okay, got it. My other question was on your capital. So your overall capital adequacy has come down to about 18%. Earlier it was excess of 20%. So any reason for a sharp decline in the past quarter?
Yes. Now what happened, a couple of things that have happened. One is that the few securitization transactions also got delayed, postponed, and so you see a sudden increase in the AUM and the loan on the balance sheet. Secondly, the investment in subsidy gets knocked off, so we can, we have some room to rationalize and optimize there, whether it's the equity debt or the guarantees given. So will be. One is that with the business growth, it might have come down, and the dividend payout also happens in the last quarter, and also there is a huge COVID provision. So the normal surplus which gets added is also low. So all these things put together have impacted. So the profitability for the for the quarter is very low because of the COVID provision, and there was a dividend outflow, and on top of that, the securitization project got delayed. So all these things are combined for it used to come down to 18.2%.
Okay, got it.
But it will improve It will improve a little bit in the whole, based on our plans and targets, it should move up as things get normal.
Okay, but why would that be? Because this.
So you have internal accruals that get added, dividend we pay in March quarter. Then the assignment transaction.
Securitization part would still persist, right? I mean,
yeah, it will persist. So that basically will take certain assets off balance sheet. And as I said, that certain subsidiary companies' investment also will try and structure in a manner that the capital, as I said, that last quarter was a little extraordinary because of sudden disruption. But so the internal accruals, the securitization, and rationalization of subsidiary investment, all these things will help us improve the capital adequacy a little bit.
But just again on securitization, just want to understand, going forward, do you expect banks banks and other players to participate enthusiastically? Because given the moratorium and worry on the underlying assets itself in terms of repayments, would they be more comfortable lending on balance sheet as compared to taking the pools?
So if you look at two things, one is that they are not able to adequately lend on balance sheet, and today they have a huge surplus liability and shortfall of assets, because that's why they put such large amount of money with RBI as surplus at reverse repo rate. Two, their own track record in collection credit is not so good, particularly for the smaller loans, and their NPAs are far higher than the industry. Three, this is not one rule applies or one size fits all, because there are some NBFCs where they have a track record and where they have comfort. I would like to believe that they do more transactions. If you look at our last 8 years track record of assignment and securitization, then our losses have been lower than what typically CRISIL or any other rating agency would estimate, or where banks would directly estimate and take into account in their pricing. So it's again question of, it's a rolling thing. People build comfort and confidence over a period of time and they do this. So our COVID strategy is that rather than doing it post facto, we'll get into some alliances with the banks where we do it simultaneously as we originate loans and don't have to even wait for, accumulate the assets and sell it. So we'll align our credit policies, processes as if we are working for the bank and originate only assets which banks are willing to take. So that 100% of assets can be given to them. And we can, hopefully that's what we're negotiating with a few banks, work out an arrangement where there's a clear understanding at the time of originating itself that this loan is to be given to that bank. Okay. Banks are very happy, very profitable for them. See what happens, their CASA and cost of fund is very low. Today they don't have much appetite to do wholesale corporate lending. So how will they build assets when they're getting deposits? So they need retail assets. They are doing their best, but they can't do on their own much. So it's a win-win proposition that way.
Yeah, thank you. I understand that. My only concern was given the current situation where there is moratorium and so on also being given on these loans. Given that scenario, they might go cautious probably for,
Yeah, you're very right. So I think, so till these things get normalized, they may be little, the things may not take off so quickly. And to that extent, as work gets normal, this will, we can expedite this.
Okay. Thank you.
Thank you. Thank you. The next question is from the line of Ashwini Agarwal from Ashmore Investment Management. Please go ahead.
Hi, Nirmal. Thank you for a very, very detailed presentation. So I have, three questions. One is the Tier 1 capital. I know you said in your opening remarks that, right now, even if you do a very large dilution, you'll be able to raise a very small amount of capital. So I'm assuming that raising equity is out of the question. But if you do stress testing and you look at your Tier 1 capital at 13.6%, you have very little room for error. So have you had conversations with your large institutional shareholders like CDC or the others of probably a convertible structure or something which might give you access to Tier 1 capital, maybe not at the current depressed prices, but if need be, you might have access to it. Have you had some think about that?
Yeah. So Fairfax and CDC, both we are in regular touch with.
Right.
And that is there on our mind. But as I said that maybe last quarter was a little bit of an exception in terms of Tier 1 going down in this manner for the reasons which I said in my response to the earlier question. But 10% is a threshold. And internally, we want to keep at least, safety of 13.5%, right? So you're right that we don't have much room here. So we are very conscious of all the options that can be convertible, it can be perpetual bond, it can be, that also qualifies as Tier 1, or it can be, all other options, and as well as, structuring in a manner that we can assign more and release the capital. But I agree with you, Ashwini, that we are very mindful of this, so we are looking at that very carefully.
Okay, and second question is that moratorium, which was a very small number as of 31st March for obvious reasons, has now grown to 58%. But what was the progression? As time has progressed and lockdown has gotten extended, are more and more people opting for moratorium, or did you put...
I think that's right. Yeah. So as lockdown is getting extended, see, most of our customers are small businesses.
Right.
All the pop stores. So, initially there were not many customers don't want to say, okay, a couple of weeks we'll manage it, rest and move ahead. But it's got lockdown 2, lockdown 3, lockdown 4, then, the moratorium has increased. because, their sources of income are shut and, so I think they're forced to take this.
Because, the reason I'm asking this is that when you look at many of the commercial banks who've also reported over the last few weeks, they've kind of given out morat numbers for April end, and they're in the ballpark of 30%, anywhere from 25 to 35% for end of April. But in the conversations we've had with them, most of them are saying that they haven't seen any increasing incidence of moratorium, principally because, people don't want to incur the extra interest cost. And especially, in the case of a bank where they feel that they may be treated, slightly differently as compared to a well-behaving loan. You've not seen that. You've seen a continuous increase in morat requests.
You see the two components of our businesses, gold loan and microfinance, they have tilted the balance, and that's why what is applicable for banks may not be applicable for us, because these two businesses account for almost around 35-37% of our total portfolio.
And here the morat rates are quite high. About 98%.
Yeah, 98% of microfinance is moratorium. So if you look at results of any microfinance company, then you'll understand the microfinance component of ours. We don't have customers like Ambani and all the Reliance or Tatas or whatever. So our customers,
the amount of money which they make is, a fraction of what they would get here. And also one thing what I see also is what is happening on the ground is developers are providing for accommodation and labor camps which are far superior to what they were earlier to attract them back. So I see the temporary blip lasting not more than maybe about 3 to 4 months.
But you are right that for 3 to 4 months impact will be there.
Okay. All right.
3 to 4 months cost and all it impacts the cost because it's all escalating.
Yeah. So thank you and all the best.
Thank you so much. Really appreciate it.
Thank you. Before we take the next question, we'd like to inform participants, please limit your questions to 2 per participant. The next question is from the line of Harsh Agarwal from Deutsche Bank. Please go ahead.
Hi, thanks for the call. And again, I think it's a very good presentation, and thanks for the transparency and being so upfront with numbers. So appreciate that. 2 questions for me. One was, can you give a sense of how much of your bank loans you've been able to get moratorium since the RBI direction came out? Just a rough sense would be helpful, I think. And secondly, your cash and undrawn lines have declined a fair bit from 31st of March till May. So again, just curious to get a sense, is that mainly because the bank loans were not under moratorium and you were likely repaying the bank loans, or what else, if anything, led to the decline in the cash and undrawn lines in April and May? Thanks.
No, you're right. So the earlier moratorium was not there. So we have been repaying, we almost ended up paying 2,400 crore rupees of bank loans and bonds due but only very recently, like the money that was due on last 2-3 days of this month, yesterday, we have started getting some confirmation of moratorium. So moratorium was not available, and we didn't want to take any chance in terms of rating, because if banks are not confirming moratorium, we don't pay, and somebody can suddenly report as a default, which can cause a lot of problems. Although we were always in touch with the bank. So this clarity has emerging only about a week ago when State Bank of India said, and a news article came that, okay, SBI has now agreed to give moratorium to NBFCs. Even today it is a little vague, but at least what was the circumstances in March and April, even in April and we had large repayments, which, so till about 15th May, for sure there was no moratorium available. After that, now I think moratorium is not as blanket and as everybody is, but still, I think most of the banks are now considering moratorium. And hopefully, almost all the banks will now agree. And that is why we have separated the outstanding, which are likely to get moratorium and not moratorium, both in our debt obligation.
Okay, got it. Thank you.
No, and to add to that, a lot of the lines and cash has been used to pay off NCDs during April and May, for which obviously moratorium is not applicable. Those are to the tune of approximately 800 crores. So those were repaid on time during April and up to now.
Okay, makes sense. All right, thank you so much.
So we have given the latest liquidity and this thing also because the environment is so fluid and volatile. So we thought that we keep investors abreast with up-to-date information.
Yeah. Thank you.
Thank you. The next question is from the line of Amit from 2.2 Capital. Please go ahead.
Yeah, hi. There was a announcement about the auditor's intention of resignation. Can you provide a bit more color on that? Like whether the auditor has already resigned or this is something that will be discussed at the next board meeting, and whether it's preferable to have a change in auditor at this current point of time given the uncertainties in the market. Thank you.
Thanks, sir. So, in yesterday's board meeting, Deloitte has given their intention to resign because they feel that fees that are being paid and proposed by the audit committee and board are not commensurate, and the expectations is not increase is 7%, but many-fold increase. Now, while I don't have any official documentary thing on this, but it looks like that most of these big fours, and last year there were 150 resignations, and there are quite a few companies that are facing similar kind of problem. So they basically directed by their global parent, they're increasing fees many-fold. They're trying to add the risk premium into it, and some of these big fours have been involved in some of the entities in the financial sector, NBFCs, banks that came under a bit of a lot of stress and default and things like that. And I have a feeling that they're trying to restrict or relatively balance and therefore downsize the practice in BFSI space and balance it, because I think over a period of time BFSI became very large component, disproportionately large component of their audit practice. So these are circumstances. Under ideal circumstances, you would not have done this. But now when in COVID we are trying to put a lot of pressure on cost optimization, cost containment, certain salary cuts, including me and all senior people have taken it. We don't want to have something which is outlandish, increase in the fee, which will be like very exorbitant. So we have been negotiating with them, but it looks like that the expectations are way too high, than what probably we can reasonably meet. So the board will take it up on 5th. We have called a meeting where we look at all the proposals, everything, and then. This last year's balance sheet and everything, that audit Deloitte is going to sign and they're going to complete. So there's no confusion or no doubt about that. So even if we part ways, it'll be very amicable, and we can re-engage if the circumstances be. But for the time being, it looks like that their fees are not tenable.
Okay, thank you very much.
Thank you. But this is a call that board has to take. So whatever I'm saying is indication, but I really can't talk on behalf of the board.
Thank you.
Thank you.
Next question is from Aman Shah from GK Investment. Please go ahead.
Hi, sir. Thanks for your disclosures. So I have one question on extending to some previous participants' question on gold loan moratorium. When we compare to a south-based peer, their gold loan is like some 90% of the customers have opted not to take moratorium, while here we feel like 90% have opted for moratorium. So both the numbers look at very extreme end. Would you be able to actually explain what would be the reasons into this?
So once again, maybe obviously would like to explain what it is in case the competitor.
So I think our understanding is, every gold loan NBFC runs different schemes in terms of attracting customers. So one of the popular schemes which a lot of other NBFCs run is around rebate schemes, which essentially means that you have a bullet repayment and which towards perhaps a 11th month or a 12-month tenure, and then as someone starts paying earlier, they start giving rebates on the loans. So essentially, those are schemes where eventually customers' repayment is an elongated one, which wouldn't have come. So that's why perhaps the moratorium figures are low. Most of our portfolio is under monthly repayment schemes. So where based on that, you see a larger number of customers, and with the branches also under lockdown, until about a couple of weeks back. That's why the numbers are higher. But now as branches have opened, I think a lot more customers are coming forward to repay, and we should see this number trending downwards.
So, if you collect monthly, there are advantages and disadvantages. But the advantages are that credit discipline is maintained, and secondly, the loans become assignable because as per RBI guidance, you can assign only if you collected the 3 installment for a short tenor loan or a 6 for a long tenor, and there's no default. And I think we have been assigning gold loans also, in a fairly significant manner. And secondly, in case of a bullet repayment, obviously, unless the bullet is falling in the time period, you really don't have to do anything because loan is not falling due only. So suppose I have a yearly scheme or a 2-yearly scheme, then maybe only about 8 or 9% will typically fall due in a month's time. Others are not falling due, then I don't have to talk about moratorium also because the loan is not due itself.
Thank you. The next question is from the line of Rocky Andaya from Lion Global. Please go ahead.
Hello. Yeah. Thanks for the very informative presentation. So just 2 questions. First one is, given the moratorium that you need to grant to your customers, how will it impact the ALM situation? Because you're a positive ALM, right? So for the next maybe 6 months, what's the ALM situation with the moratorium that you're granting to your customers? And the next question is, I think you bought $15 million of the dollar bonds around April. So is there a plan to increase more or to buy more US dollar bonds going forward? Or do you have any approvals from RBA to do such thing? Yeah, I think that's all for me.
No, we don't have approval from RBI. So I think still we have approval from RBI. We really can't, do any buyback more. But 15 million we did in the month of March. And in terms of moratorium, impact will be, so if you're getting, say, money for the moratorium from bank, then obviously, the ALM improves. So if you look at the chart that we've given, then even if you don't get moratorium from the bank, then also our ALM for next few months is taken care of. And obviously we can securitize and raise more funds. But if the moratorium is corresponding from the bank, then ALM is not impacted as much.
Okay, so just to clarify, if you don't get moratorium from the banks, you will have basically negative.
But yeah, so that will dip into our liquidity or the reserves that we keep. But we have provided for that. So even if you don't get moratorium from banks, we can sustain our operations and liquidity, for next 6 months at least.
Okay. Yeah. Thank you.
Thank you. The next question is on the line of Rajiv Agarwal from Doordarshi Advisors. Please go ahead.
Yeah, hi. My first question is on the gold loan segment. You seem to be quite bullish about it. And some of your peers who have reported the numbers also seem to be very bullish about it. So are you seeing increased competitive intensity in that space? And how is that impacting the business?
Competition, I think, has been increasing in that space, but again, it's a very steep learning curve in terms of to get everything right, from testing the gold to getting the right kind of customers to storage, security, and getting the product yield, everything. So actually, we have been building this business over a period of time. Also, this business traditionally has been done like a consumer business with advertisement marketing. So if you see some of these gold loan companies, they always use celebrity models to create the brand awareness. I don't know if you noticed, so we also signed up and Rohit Sharma, who's a cricketer, has become our brand ambassador. So it becomes like a consumer product business that in local area, you create the brand awareness. So it's competitive. And I think in India, any growing business will have competition. But we would like to believe that we've been doing this business for 10 years, so we are much higher on the learning curve. In terms of understanding the nuances of the business is very important. So, it's competition there, but we are not overly concerned about it.
Got it. The second thing is, can you talk a little bit about total amount of disbursements you would have done from end of March till sort of the May 15th, where you have reported your ALM? Because I still have the question around, how the ALM or the total cash plus bank lines have come down from more than 5,000 crores to 2,200. So I just want to see how much of that is driven by the disbursements that you have done.
5,000 crores, no, we are... Yes. So we have, as I said, 2,400 crore rupees of bank loans we are repaid, 800 crores of debentures we are repaid. So broadly, that's the explanation. But most of these repayments are due in 31st March and April. They have been repaid.
So how much was the disbursement you said? I missed that.
Disbursement was significant, but I'll just check. What was the disbursement level? Do you have the data for disbursement?
Okay, so while you're checking that, one more question from my side, and that is, if I look at your assignment income, the assignment income seems to be pretty good, around 5% of the amount assigned.
Sorry, can you repeat?
The assignment income, the percent of assignment income as a percentage of the assigned assets is around 5% plus.
Right.
Is that something that is sustainable?
Yeah, that's quite sustainable because more like gold loan or our businesses have a higher operating cost and a higher margin. So this would be sustainable. The total disbursements would have been little less than about 100 crores kind of thing, not significant.
100 crores in the last 1.5 months.
Yeah, maybe slightly less than that also in a month.
Oh, great. Those were my questions. Thank you.
Thank you so much.
Thank you. The next question is from the line of Abhiram Iyer from Deutsche CIB Center. Please go ahead.
Yeah, hi. Thank you for taking the question. My query actually pertains with respect to the loan increase that you were talking about. You mentioned that you're targeting to raise around 4,000 to 5,000 crores in the next 2 to 3,000 crores in the next 4 to 5 weeks. Do you have any sanctions which have been granted, or are these still in preliminary phase in terms of raising funds?
So there are various stages actually. I would say that there are confirmed sanctions, otherwise we'll draw the lines also, or but there are various stages. So the whole banking system, has been, and maybe I would like to believe that's true for the entire NBFC sector, not us alone, that they've been waiting for a clarity on guidelines from government and RBI about the credit guarantee, risk, the liquidity schemes and all those things. They've been just done very recently. So I have a feeling that maybe next few weeks we'll see good amount of disbursement, but nothing much has happened in the last 2 months.
Got it. Then coming to the liquidity, are there any cost rationalizations that the company is planning? Is there any cost cutting measure, or is there any branch closure measure that the company is thinking about?
Cost cutting, yes. Branch closure, no. So we have the hike, and we also have not reduced number of people also, and more or less our employee strength in March and in April end is similar, maybe 1% or 1.5% difference. So the high cost people are taking a salary cut. We are trying to rationalize the branches and many other costs, including travel, and we are trying to cut down on the marketing activities which take place in local. So the salary bill has been brought down by 10-12%. The operating costs, we are targeting to bring them down by 30%, 25-30%. So a lot of work is happening on that front also. The great opportunity to rationalize costs in this kind of environment, and with the new revelations that have happened about how much people need to travel and where people can work from, and what kind of productivity we can target. So I think a lot of effort is happening on cost rationalization.
Got it. And the last question is actually pertaining to the assigned assets. I'm sorry, I'm not just, is there a way that I can see with respect to the previous years how the assigned assets work and how the income works? Because I see that there has been a chart provided on page 13, but that doesn't sort of correspond to whatever the historical assigned assets are and the income that has been provided are.
So that is included, the assigned assets AUM. So if the assets are not repaid, then that's based on the assets.
Okay, so just other understanding, the 575 crores that is being mentioned, and the 5.8% income that is being mentioned, that is on the base of the 9,700 crores that is being earned as assigned assets.
Absolutely right.
Okay. And that 500 crores will, if this assigned asset remains constant, that 500 crores will come in, 570 crores will come in every year.
Absolutely right.
All right. Thank you.
Thank you.
Sorry, apologies. Just one more question. Sorry, it's in my notes. I forgot it. Can you let me know what the in terms of the bank balances, how much of them has liens assigned to them?
Come again?
So you mentioned that there are 2,200 crores of cash and undrawn lines. Are any of them lien marked?
No.
Okay, those are not lien marked. Thank you.
Not in this. So this is 2,200. This is not anything which is lien marked.
Okay, got it. Thank you very much.
Thank you. The next question is from the line of Pranay Zaveri from DNJ Holdings. Please go ahead.
Good afternoon, sir. Thank you for the opportunity.
Yeah.
Can you just throw some light on the gold loan PTC, which are not to the banks but to the retail and retail customers? So how is the yield over there for our company, since you offer some higher buffer in terms of security as well as some personal promoter guarantee also? I'm just trying to understand this product.
No, we don't have any promoter guarantee product. And we don't have any loan against shares which are with promoter guarantee.
Not loan against shares. This is gold loan PTC. Gold loan pass-through certificates I'm referring to.
Yeah. Tell me.
So in that, basically, how are the yields compared to the assignments that you've given to the bank?
So gold loan PTC may be slightly higher, but as a part of our strategy to diversify and have a different sets of investors and providers of money, we are working on this. So, here we end up giving about 10% plus, maybe around that range. But with banks, probably we can work at 9%.
And how big is that in the total assignment?
Not too much. Gold PTC?
Yeah.
Not very significant. I mean, maybe it's not even 4-5% also of our total assigned portfolio. It'll be less than that. I don't have the numbers, but not very much.
So just one question over there. Suppose there is some in this specific instrument of a PTC, if there is some higher delinquencies, would that affect the rating of that pool, and in turn would affect the whole pool, right?
So in gold, it's very unlikely to happen because historically delinquencies are low, and you always have option to auction the gold and repay the loan. So the defaults and delinquencies are very few and far between.
Okay, sir. Thank you.
Thank you.
Thank you very much.
Thank you so much.
That was the last question in queue. I would now like to hand the conference back to the management team for closing comments.
Thank you so much. I think we're fairly long, but we are very happy to answer more questions. If you have, you can email it to our investor relations manager, Pooja Kashyap, and she'll be very happy to respond. And so take care. Thanks a lot.
Thank you very much.
Bye.